Okay, thank you very much for having me here. This is the 21st annual conference, and I was looking back at my calendar, and I realized I came also to the 5th annual conference. And so I'm also extrapolating from that, I'm thinking to myself that I will be back here in the year 2032. So I look forward to that. So this paper is joined with Viral Acharya. Viral was at NYU until about a year ago, at which point he moved to the Reserve Bank of India, where he's a deputy governor. And so there's a disclaimer down there that is from the RBI. And what is this paper? Basically, this paper is, it's the result of a conversation that Viral and I had been having about trying to understand the capital controls that India has in place, especially some of the changes around the taper tantrum. And India really has kind of a patchwork of capital controls, so that as we were talking through this, we were trying to fit this patchwork within a framework, a kind of a macro-proof framework that we can understand. And so what I'm going to talk to you about is, I think, the result of our thinking about what India has done and putting it into the framework of a model. Okay, so there's the outline of this talk. I'll spend a little bit of time on some data. I think I'm guessing for everyone in this room, the data I'm going to go through is very familiar. It's just how the world has behaved over the last few years after the taper tantrum, and how especially emerging markets have behaved. And all of the themes that I'm going to be talking about, sudden stops, reversals, this should, I think, be all familiar for everyone in this room. Probably what will be more interesting is to show you some of the data from India and how India has developed over the same period. After doing that, I'm going to walk you through a model. And the model is one in which we're going to model an emerging market in which the emerging market has multiple instruments to deal with a sudden stop. And I think the interest in the model, say, relative to other work, is it's multiple instruments. It's very common to write down sudden stop models in which you ask questions about what the optimal level of reserves are. It's also very common to write down models in which you think about things like taxes on capital inflows as a way of dealing with sudden stops. And I think what we're interested in doing, and in a way it's because of the fact that there are multiple instruments in India, it's this patchwork approach that India's taken, that we wanted to think about these things together and see what comes out there. And there's a result that I'm going to emphasize, which is that reserves and capital controls are complements. And I'll spend some time talking about that. And then the last thing that I'm going to do in this talk is I'm going to go back through India, and I'm going to talk about, as I said, kind of organizing some of the things that India has done through the lens of this model that I'm going to go through. Okay. So let me start here. This is just a picture of capital flows into India. And you can see a couple of points here that you'll all recognize. So blue line here is what I should be focusing on. So does this? This is the global financial crisis in which foreign portfolio flows really fall. This is the taper tantrum in which they again fall, and they go back up again in 2014 after the taper tantrum. This is annual data, by the way. And then they come down again when the Fed starts to raise rates. Okay, so this is just a picture. I have a feeling this is very common across many emerging markets. And it's the volatility of these capital flows, which is, of course, the concern for sudden stops. The taper tantrum was a period in which India was quite badly affected. So this is the exchange rate, the red line here, over time. And the outlined yellow part is the period of the taper tantrum in which the Indian rupee depreciated quite dramatically, not just on an absolute basis, but also relative to other emerging markets. So the blue line here is a emerging market currency index, and you can see that India did quite badly over this period. And at some level, this period is also surprising, because this is a picture of foreign exchange reserves in India over the last 15 years. And you can see that Indian foreign exchange reserves have basically been going up over this entire period, and dipped slightly in the crisis, and then have continued to go up. So if you just looked at foreign exchange reserves, you'd walk away saying that from a buffering standpoint, India looks like it's in quite good shape. The difference, though, and the picture changes completely if you start looking at short-term debt. So as reserves have gone up, the other thing that has really grown over the same period is the external liabilities, the short-term debt liabilities, particularly of India. And you can see this here. This is the blue set of graphs, and that's gone up quite dramatically over the same period at which reserves have gone up. And I'll talk a little bit about the downturn afterwards. If you put this together, the green line here is reserves minus the short-term debt relative to GDP. And it's an interesting metric because it's kind of like a liquidity coverage ratio, right? I think I understand in reading the literature, there's a Greenspan-Guidotti rule that a central bank should have an equivalent amount of reserves to cover its short-term debt. So that's what this metric is based on. And you can see, if you look at this metric, you realize India does not look so good over this period, this green line here, over this period pre the taper tantrum, right? And in a way, this green line is the story of India. Reserves are going up, but debt is going up in some ways faster, so that by 2013, this ratio has fallen quite a lot. In fact, quite a lot even relative to what it was in 2008. And there's a change over here in 2013-14, and we interpret some of that as changes that are due to some of the controls that India imposed. Okay, so this is a story about India. And the next picture I'm going to show you is just to ask how much this story of India applies to other emerging markets. So what I'm going to do is I'm just going to construct a liquidity measure along the lines of this green line that I just showed you, which is the difference between reserves and short-term debt divided by GDP. And I'm going to ask how well across country does this liquidity measure tell you about exposure to the capital flows post-2013, taper tantrum and beyond. And I'm guessing that you will probably recognize what this picture looks like. This is a collection of emerging markets around the world. I'm looking at it and I can't see clearly here, but I think Chile is one of them. But there's a bunch of emerging markets here. And the thing that I want you to notice here is, so the left-hand box here is the change in the sovereign bond spread in a country, the stock market return, the domestic stock market return, and this is the currency appreciation. This liquidity metric actually does a fairly good job of discriminating in the changes in bond spreads, returns, currency appreciation. I should have told you this before. This is asset price changes from June 2013, so the start of the taper tantrum, to October 2017, which is a period in which you had a capital outflow, a capital inflow, and then a capital outflow again. Okay, and over this entire period, this liquidity metric does a fairly good job of discriminating against how these countries are doing. There's some more that we do in the paper. We also look at this at a high frequency analysis, and we construct a global factor kind of along the lines of Ellen Ray's work. And we ask, does this liquidity metric at a high frequency discriminate among the exposure of countries to the global factor? And you can do that simply through a regression by asking, when the global factor looks bad, do countries with better liquidity do relatively better? And the answer is yes, and you can just do that by interacting the global factor with liquidity, and I'm not going to spend too much time on this, but it goes as you would expect. At a high frequency, you also see that there's this interaction effect between exposure and this liquidity metric. Okay, so let me now step back. I talked to you a lot about India. So India had a picture for foreign reserves that looked a lot like this, but now this is across a collection of 10 emerging markets. And this is a picture that I think also will be familiar to all of you. Emerging market foreign reserves have gone up quite a lot over this period after 2007. And the picture for the entire emerging market world is that external short-term debt has also gone up, almost mirroring the increase in reserves. And the regressions and the other pictures that I've shown you suggest that it's the difference, really, at some level, that one should care about from a vulnerability standpoint. So that's what I'm going to make this point, and then I'm going to move into a model. Okay, so based upon the data I've shown you, and based upon really an introspection, you kind of know that it should be the difference that should really matter, which suggests that when one thinks about capital flow management, one has to think jointly about both reserves as well as short-term debt. Now, I'm not saying anything that you don't know. In the data, these two things move together. That's a fact. Why do they move together? Well, there's one obvious reason. There's co-movement via capital flows, right? Capital inflows, you accumulate reserves. And if the capital inflows are in the form of short-term debt, you will accumulate reserves. There's a second point that is not obvious from the data and is going to be obvious once I take you through the model, which is that they're jointly determined. And in particular, the model that I'm going to take you through is going to suggest that the reserves causes the short-term debt. That is, this is not just correlation, and there's certainly a common factor that's driving this, but I'm going to make a second point, which is that the growth in reserves also likely caused part of the growth in this. And if that's true, then you realize that both of these margins are relevant margins when one thinks about how to manage capital flows into an emerging market. Okay, so that's what I'm going to do next. What I'm going to do next is I'm going to take you through a model which tries to think about both reserves and short-term debt within an integrated model. And the main result of the model that I want to emphasize is that these tools, reserves versus capital controls, particularly against short-term debt, are complements. That's really the main emphasis that I'm going to make, and I'll try to say this in a couple different ways. Okay, so what is the model? I'm not going to take you through too many equations. I think Marcus and Ricardo did enough of that already today, so I'm just going to walk you through a model where I'm just going to sketch the model. If you want to see equations, I'd say look at the paper, but the model is sufficiently simple that I think I can talk it through and you'll understand all of the elements of the model. So what is the model? This is based upon some older work that I have done with Ricardo Caballero, which I think I presented here 15 years ago. And it's a mix between that paper and a more recent paper that Ricardo has with Alp Simsek. And I'm mixing those together, and that's the model that I'm going to show you. Okay, so the model is a 3-date model. There's an investment date at date 0. There's an interim date in which you might get a sudden stop at date 1, and then there's a final date, date 2, where cash flows are realized. So kind of like a Diamond-Dybvig style model, if you want to think about it. There's a domestic borrower who has a high return investment. There's a foreign lender who's going to provide the capital for this high return investment. And there's a central bank in the background who's going to do some type of capital flow management. Okay. This domestic borrower you want to think of as a firm, a bank, anyone who has access to a high return investment, takes on a liability at date 0 L from the foreign lender, invests this domestically. There's an exchange rate in this transaction, which I'm just going to normalize to be 1. And in fact, in my talk, the exchange rate, other than the crisis state, is always going to be 1. Okay? There's going to be an exchange rate only showing up in the crisis state. All right, so I'm going to start off by running through the model in which the liability is in external debt. So it's in dollars rather than in domestic currency. I'll add domestic currency debt later on in the stock, but for now, let's just think of foreign external debt, which is actually the picture that I showed you before. All right, so the liability is in dollars or in foreign currency. It's short term, which is to say it needs to be rolled over at date 1. That's an assumption of the model. So this looks very much like a Diamond-Dybvig style analysis. It's due at date 1, and cash flows are due at date 2. Okay, so you must roll this over. The key assumption of the model is really this one, which is at date 1, there's a chance that you're going to get a retrenchment. Sort of the capital inflows from the foreign investors are fickle. They can turn and run, and that might happen with probability phi. If that happens, then the domestic borrower has to refinance this locally. And if that happens, there's going to be some disruption in the process. Okay, so here's the disruption. So at time 1, as I said, there's a retrenchment risk. So again, if this retrenchment risk doesn't realize, then everything works out okay. You live till date 2, you get the high cash flow, you pay everyone back, you can roll over your debt, and then you can go on vacation. The issue really is in this retrenchment risk. So there's a chance that you'd get this retrenchment shock. It happens with probability phi. You'll see fees showing up in a couple places. If it happens, then this firm has to find some way to pay back the external creditor. How does it do it? The way we model it is it has some collateral L, which it borrows against or it liquidates locally, and then it converts that into foreign currency. In doing so, it converts at an exchange rate E, which is less than 1. So 1, if you remember, was the normal state. So E is the crisis state, exchange rate less than 1. And that means that this domestic borrower now has a shortfall, which is the amount of borrowing that it has to pay back times 1 minus E, the depreciation in the exchange rate. Okay? And our assumption is, in this case, there's going to be some disruption. So in particular, there's some form of a liquidation or a bankruptcy cost that our borrower suffers, which is just proportional to the shortfall. Okay. So with just this model, you can kind of imagine what the capital structure of the firm at time zero is. The firm is making a borrowing decision. It has a high return investment. On the other hand, it thinks to itself, oops, I could get myself in trouble if there is a retrenchment state. If it happens, I won't have enough money to pay back. If I don't get enough money to pay back, I'll suffer bankruptcy costs. Okay, and that will give you an interior solution for how much borrowing the firm is going to do at date zero. Now, a key variable in how the firm is going to do borrowing is this bankruptcy cost. Right? And notice in particular that it depends upon the exchange rate E. So the last step in the model is to close the market for the exchange rate. So what we're going to assume is that there's a central bank which has reserves of X. And for my next two slides, let's just take X as fixed. I'm going to optimize over X in two slides. So let's just take X as fixed. And so our assumption is going to be that the exchange rate is just proportional to X over L. So you can think of this as, L is trying to get out. X is being supplied by the central bank. So if the central bank has more X, then E is higher. If there's more money leaving, more L going out, then the exchange rate is going to be more depreciated. Okay, so I think a fairly natural function. And then just plugging E into here, you realize that the equilibrium bankruptcy cost suffered, so conditional on a value of X, is beta times L minus X. Okay. I think I'm going to cancel. All right, I canceled. All right, that was the sudden stop state. All right, so as I said, you can think about this now and ask, how does a firm choose its external borrowing? And as I said, it's just a trade-off between getting a high return investment and suffering this bankruptcy cost. So the key variable that enters into the bankruptcy cost is this price E, right? And it affects the liquidation cost. And you noticed, as I mentioned before, that the price E increases in reserves and decreases in external debt. So if you work out in this model what the privately optimal choice of borrowing is, the answer is your privately optimal borrowing will depend upon phi, the sudden stop state. If it's much higher, you'll borrow less. It also depends upon E, because E parameterizes the bankruptcy cost. And moreover, there's a difference between the privately optimal L and the socially optimal L. Why? Because the socially optimal L takes into account that E depends upon L. In fact, you can see the way I've written this down, it's very clear that there's a distinction between private and social. The private value of increasing L is proportional to 1 minus E. The social value is actually linear in L. X drops out, right? And as long as E is less than 1, it's always going to be the case in this model that the private sector will borrow more than the socially optimal L, right? So far so good. I think this makes total sense. In a way, what I've just shown you is in keeping with the whole collection of fire sale style models. If you endogenize the fire sale price, you will generically find that there will be socially too much borrowing, all right? Where I'm going to go next is I'm going to think about how X enters into this. X is a choice of the central bank, so that's where I'm going to go. All right, before I do that, as I said, this is all familiar. How can the central bank do better? Well, it could just set L to the right level, if it could just figure out exactly what L is. Or what is maybe a more popular way of thinking about this is you can imagine a Pigouvian tax, imposing a tax on the difference between the private and the social value of borrowing, and that'll hit the social optimum. All right, so my next result is I want to now think about X. All right, so what is X? X is the level of central bank reserves. And the central bank is accumulating reserves during the capital inflow boom. Now, how much reserves should the central bank accumulate? So there's two cases we can think about. So first, think of a case in which the central bank has no ability to tax capital inflows, right? In that case, if the central bank increases X, it increases E, which means it actually increases the wedge between the private and the socially optimal values of L, right? Effectively what happens is if the central bank can't control L directly, if it can't impose a Pigouvian tax, then if it holds more reserves, the private sector says, whoops, it's great, liquidation is not so bad because the central bank is bailing me out with reserves. So the wedge between the private and the social value is actually increasing in foreign reserves. So if the central bank can choose its level of reserves, and it can't set capital controls, the optimal level of reserves is a small number. If the central bank, on the other hand, can choose both the level of L, set the tax, as well as choose the level of reserves, the central bank will hold a higher level of reserves because it can choose a high enough level of reserves such that it can also set the tax rate such that there isn't this undoing problem that happens when it can't do it. Another way of saying this is that the two tools, the two instruments here, holding reserves and setting capital controls in this model are complements. If you have access to the tool, which is capital controls, you will optimally choose reserves higher. Why? Because the marginal benefit of holding an extra reserve is higher when the private sector can't undo your holding reserves by borrowing more. Vice versa, if you have access to a technology which allows you to accumulate reserves, let's suppose foreign treasury yields or Marcus's safe assets are available, actually that means that you should spend more of your time worrying about capital controls. The marginal value of capital controls are higher with higher levels of reserves. So that's clear from the model, but if I just step back and I reflect on, particularly for us, for thinking about the experience of India, I think when you think about the sudden stop problem, your first pass at thinking about this is, if I can't do capital controls, then the answer is I should just hold more reserves. Right? I can't do this. In the sudden stop state, what matters is the difference. If I can't do capital controls, I should hold more reserves because I don't have access to this other way of dealing with this problem, so I should hold more reserves. That sounds right when you first think about it. Or you might think about the other way. If I don't hold reserves, I should impose capital controls. It's very natural to think about capital controls and reserves as substitute instruments. But as soon as you think about the fact that the holding of reserves affects the level of borrowing of the private sector, you realize that actually they're complements. And that if you can't impose capital controls, you shouldn't hold many reserves. You should hold very few. And in the model, the answer is the level of reserve holdings and the level of capital controls should go up together and down, rather than what you would expect if you had a view of these two instruments as substitutes. OK. Let me do a couple more things to this model. The first thing I'm going to do, and this is largely to just talk about some things that India does, is you can put heterogeneity among the firms. So far I have a single firm. And in the single firm, there's this retrenchment state, the bad state in which people pull out. So let me put in heterogeneity among firms. And in particular, let me assume that firm I faces liquidation retrenchment state with probability phi I. And you can write down the exchange rate market clearing condition as x over the integral of phi I times Li. Okay? So all I've done is previously I had a constant phi and a constant L for every borrower, and I'm just going to integrate across these two. So if you work out this model, what immediately becomes clear is the Pigouvian tax should vary across borrower identity, and it should actually, in this simple model, it should be proportional to the ratio of these probabilities of bankruptcy. Firms who are more likely to be run on should carry a higher tax. Why? Because they're creating more of the fire sale externality than firms that are less. Okay, as I said, I'll come back and talk about this through the data. So the last thing that I'm going to do in the model is I'm going to add domestic currency debt. So what I've done so far is I've written down a model in which all of the debt was external, say, dollar debt. Now I'm going to add in domestic currency debt. So in particular, I'll allow our borrowers to borrow in either foreign currency or in domestic currency. I'll assume that if foreign investors lend in the domestic currency, there's an additional cost of S, informational cost, whatever you want. There's just an additional spread of entering the local market to borrow. And otherwise, I'm going to keep the model symmetric. So in particular, in the retrenchment state, it's about foreigners. It's not about the type of debt. Foreigners will want to exit even their domestic currency debt, convert their proceeds into foreign currency and exit. Okay, so that's the assumption. And then what will the local borrower do? He'll roll over his debt locally. And the assumption, which is symmetric to the assumption I'd made before, is you can roll over your debt. You can always find local currency to roll over. There's borrowers out there who can roll over your debt. All right, so this model now has sort of a twin crisis. You can get a domestic currency rollover run, which you can think of as some sort of bank run. If that happens, then you get pressure in the exchange rate that's just not coming only from the foreign debt, what I started off with, but also on the quantity of domestic debt from which investors are running. So the exchange rate is decreasing in both LF and LD, LF being the foreign debt and LD being the domestic debt. And then ex ante, if I'm a lender to this in this domestic market, I will ask for an interest rate that depends. This should be a spread RD over R being the external interest rate, which is S, the spread, plus the probability of the depreciation state times the amount of depreciation. Okay, fairly standard. This is you're gonna in this model you're gonna ask for an extra spread plus expected depreciation as a foreign lender, and that's what will set the domestic interest rate. All right, so we can run back through this model. Now I have two margins. I can borrow externally. I can borrow locally. If I borrow locally, I pay an extra spread. If I borrow externally, I don't pay that spread, but I run into potential bankruptcy costs. So there's an interior optimum where you'll want to do a bit of both. The way we set up the model actually in the paper is we set it up so that you go to either one corner. You either borrow all externally or all domestically, but in general what you'll do is you'll do something in the middle where you'll borrow a little bit of one or a little bit of the other. All right, so let's now come back to the central banking question. So the central banking question, as we had described it before, was I showed you the reserves and capital controls were complements. Now I can ask the same question in this model where I have another margin, which is domestic currency debt. And what we had before was you would want to tax the issuance of short-term external debt. Now in this model now with domestic currency debt, what will happen is if you just impose a tax on the external foreign currency debt, you will incentivize firms to expand the domestic currency margin. Right? You put a tax on one thing, you'll get migration into the other margin. And because foreign investors run at date one, regardless of the debt instrument they're holding, and either run depreciates the exchange rate, it then follows that domestic currency debt also creates an externality. And you can see that very clearly because E depends on both LF and LD. And if someone borrows more LD, they push E down, which increases the spread to everybody. Right, so there's an externality that shows up in the same way for both foreign currency debt and domestic currency debt, which means that the optimal policy has the central bank acting on both margins. Right, if you just do it on one, you're going to create more of the other, and both of them create externality. So you want to do both margins. Right, so then the second result, which is if you want just a corollary to the first one, is suppose you have only one instrument. Two instruments. Suppose you could only tax external debt, and you can only hold reserves, but you can't tax this other local currency debt. Then what would you want to do? Well, you'd want to set a strictly lower tax on the external debt because you're worried about this migration problem, and then you also want to hold less reserves. On the other hand, if you could tax all margins, you'd want to put a tax on domestic currency debt, foreign currency debt, and you'd hold more reserves. All three margins will move up and down together. And again, it's just making the same point. They won't be substitutes. They'll all have to be moving up and down together. All right, so with that, let me talk a little bit about India. And most of what I'm going to say is pretty descriptive. And I think maybe some things I will tell you are not aware of, but most of these things should be understood. So what does India do? India has a collection of capital controls, and I've tried to group them together. We've tried to group them together into sort of four things. And I'll talk through all four of these things. They have caps on external borrowing as well as domestic foreign portfolio inflows. I'll talk about them in a second. There's caps that vary by instrument. There are caps that vary by the type of borrower. And then there's some arbitrage things that I'll have to talk about. Okay, so let me start first with the caps on borrowing. So India has three forms of debt that kind of interact with foreign investors. There's external commercial borrowings. A lot of the external commercial borrowings in India are typically loans to Indian companies. I think this is maybe a little bit different than many other emerging markets in which it's the financials who are very much in external markets. In India, it's actually the multinational companies that are in external commercial markets. There's also foreign portfolio investment in domestic currency debt, both as in government securities as well as corporate securities. And then there's a third type of bond, which I'll come back and talk to, which are rupee-denominated bonds, what are known as masala bonds, that are issued overseas and typically in London. These are not issued domestically, they're issued abroad. There are caps on all three types of these instruments. So kind of just looking back on the history, I think somewhere in the early 90s, there were significant caps that were starting to be hit, particularly on external commercial borrowing. These caps have gradually been increased. They've covered more and more instruments. Currently, these are what the caps look like. These are absolute quantity limits on how much you can borrow. There are caps on how many government securities you can buy in a given year. There's caps on state and local development banks as well as corporate banks. And then there's a total cap currently of around $130 billion, and these caps keep increasing. Just a comment, when we looked at these caps, one of the things that jumps out is these caps are sized to the market. They're sized to market size. The government bond market is bigger, so they're sized to the size of the market. That looks very microprudential. Okay, I'll say a bit more about that. Yeah. Right. So a couple of things. First of all, these caps are, as I said, sized to the market rather than sized to the entire market, sized market by market, which in a way from a macro standpoint doesn't make sense because what you care about is total external liabilities, not individual. So it's not obvious why that's the case. Second, the caps are actually set on flows, not on stocks. The way the caps are implemented is there's implementation of, in a given debt issue, how much foreign investor participation there can be. So they're in flows, not stocks, whereas from an external vulnerability standpoint, it's stocks that matter, not flows. And then last, and this is just repeating the point that I made, there's no sense in which they depend on the level of FX reserves. My analysis says that the marginal value of these caps depends upon the level of reserves, and the level of reserves depend upon the marginal value of these caps. They should all be moving together, but that is clearly not the case in the world. Now, one of the questions always when you think about capital controls is to ask, is it actually effective? I think that was the purpose of Alvaro's paper that we talked about early. And India has an interesting thing that they do in which you can actually see that they are effective. What India does is, as I said, they have caps. The caps are per issue. And if foreign investors start to hit up against the issue level cap, they auction off the ability to buy that issue. Right? So you pay the same price as the general auction, but a foreign investor participating pays an additional fee that depends upon hitting this cap. Okay? In a world in which investors can evade the capital controls, you would expect that fee will be zero. That is, when you auction off the ability to participate on the limited cap, you would see that the fee would be zero. Here's what the fee actually looks like. And this was a nice result that we saw in the data. It's low. This is the taper tantrum period. 2014 capital flows start back into India. It goes up. This is about 80 basis points, 60 to 80 basis points, and then it goes back down in the period in which capital flows reverse. The very fact that this goes up above zero indicates very clearly that these controls are in fact effective. In fact, one of the things that I learned from doing this is actually this is kind of a good way of assessing whether controls are working or not. If you auction off your capital control and nobody buys your auction, then you know it's not working. If it's working, then you know it's working. And moreover, this number here is actually is exactly the level of the Pigouvian tax that I would write down in my model, right? Set the cap, let the market clear. What is the wedge? That wedge will be exactly the gap between the social and the private value. And I'm sure this is not their intent, but it's actually quite nice to see that this, in fact, lines up with what we think. The way in which the demand in this auction has worked also lines up fairly well with the movements in the Indian exchange rate. There's a period in which you start hitting the cap. This is a period in which the exchange rate appreciates. There's a period in which you don't hit the cap. This is a period in which the exchange rate depreciates. So, which makes total sense. India does a bunch of other things. They limit investment maturity. And a lot of these limits on investment maturity were really imposed after taper tantrum, in which they limited foreign investor participating in short-term debt markets locally, which makes total sense. Of course, again, those limits really depend upon the level of reserves, and which is not being done, but that you can sort of see how this would play out. And then a third thing that India does, which is kind of interesting, is that they ration high liquidity demanders. And the way they do this is they have their external borrowing caps are a function of the rate that you issue when you issue external borrowers. In particular, there's an all-in cost ceiling on a debt issue, where if you issue your bonds at too high a rate, you're not allowed to issue those bonds. So as the level of credit rating of a company, as perceived by market, as perceived by bond issuance, starts to kick up, the cap starts to tighten. which is very analogous to my analysis of heterogeneity across bond issues. And then let me say one last thing, which is one of the recent things that India has dealt with, and this is my last slide and I'll be done, is they have introduced a second measure. So there was a change in the Indian debt issuance, external debt issuance, in the last year, where a lot of companies, when they hit their ECB cap, their external dollar borrowing cap or euro borrowing cap, they went out and placed bonds in London which were in rupees. And it was substitution. In fact, if you look at the data, it's very clear that the companies that were issuing these bonds were exactly the companies previously which were capped by their external borrowing. That's very suggestive that you really want to tax both margins, which is in fact what India does. And starting in 2017, they also taxed this rupee margin along with the other one. Okay, so that's the last thing I wanted to say. If I wanted to summarize my analysis, and I've taken you through some data on India, India kind of fits the lens of many emerging markets. We've tried to think through the various things that India had done. And overwhelmingly, as I've talked through this, the main thing that I took away from this is it makes sense to think about all of these instruments as complements rather than substitutes. So let me stop there.
Thank you very much, Arvind.